You should sell your Tesla stock if you don't believe in the company. These are the words that Elon Musk used in the latest Tesla's earnings report, and he is right. Why would you invest in a company you don't even believe in? The stock went down over 10% after reporting a mixed earnings report. So we're going to take a look at what happened and the outlook of the company. Let's dive in. The company's revenue is divided in three segments: auto, energy, and services. Year over year, the revenue for auto dropped 7%. Energy increased to 100% and services increased 21%. For the auto segment, the decline is due to less production of vehicles, therefore less deliveries. Also adding to the equation that Tesla reduced the price of their vehicles in order to sell them, putting a dent into the revenues and profit margins of the company. For the energy, both Megapack and Powerwall achieved record deployment in Q2, resulting in 9.4 gigawatt hour of total storage deployments. Overall, the energy business achieved record revenues and gross profit in Q2. Both megafactories are on track to continue their rapid production. I don't see this section of Tesla slowing down. We are living in a world of constant climate changes that could cause power interruptions. A lot of consumers are opting for energy storages either as constant use or emergency uses. This energy storage will be needed even after becoming a staple worldwide. For services, most of the profit margins in this segment was driven by collision repair. It looks like Tesla drivers are having some sort of problems driving. To have collision repair to overcome the supercharging network revenue is wild for me to think about. Talking about supercharging network, Tesla is expecting to expand and deploy more capacity, making the network to reach non-Tesla electric vehicles. Over time, the network utilization should increase, driving revenue growth and profit generation. The net cash from operating activities came with an increase of 18% year over year, standing at $3.6 billion. Capital expenditure increased 10% year over year, coming up at $2.2 billion. As investors, we don't like when capital expenditure goes up, but as long as the money is used effectively and cash is growing, then it should not be a red flag. Taking operating activity cash minus the capital expenditure, and we got the free cash flow of $1.3 billion, which is 34% increase year over year. And last, cash balance of the company sitting at $30 billion, a 33% increase year over year. Taking a glance at the outlook and future guidance of the company, we have the volume. It states that the company is on two major growth waves. First one is the expansion of the Model 3 and Y platform, and the second one is the advancement of autonomy and the introduction of new products. Tesla indicates that in 2024, vehicles volume growth will be lower than the growth in 2023, since the team is working on the launch of the new generation of vehicles. With that being said, we will see the energy generation segment outpacing the vehicle business. In cash, the company has enough liquidity to fund their long-term plan and expenses, while doing cost strategies to maintain a healthy balance sheet. Profits, as mentioned in the segment above, the company will continue to execute new projects and innovation while maintaining or lowering the cost of manufacturing over time. And last, the products. The company is working on affordable models starting as early as the first half of 2025, cheaper vehicles with the same quality while being manufactured in their already created warehouses, which diminishes expenses. I can understand the reason why the company went down. When we look at the revenue per segment, auto is by far their largest revenue. Combining services and energy generation together, it is 5 times smaller than what auto brings in revenue. By stating that car production will be lower for the rest of 2024, investors immediately opt by selling their shares. They see it as a sign of short-term weakness, as your biggest revenue will bring less money. Personally, I see energy growing, but not to the rate of offsetting the revenue miss by a slow auto segment for the rest of the year. So is the recent drop valid, or investors are overreacting? Is Tesla overvalued? I know Tesla's highest revenue segment is auto, so investors view it as an automobile company. If you view it with those lenses, then yes, Tesla is overvalued. By nature, car companies have high capital expenditure and low return on capital employed. By seeing Tesla as a car company and having their biggest revenue, which is selling cars, slowing down, then yes, the company is overvalued and the drop is justified. On the other hand, if you view Tesla as an innovation company that creates cars, energy storage, autonomy, creating robots that could assist humanity, and software that could be sold as software as a service, then the drop could be a buying opportunity for the long term. term. Tesla is not fully mature. They are growing and innovating with what they have as of right now. Time will tell where the business is being headed to after this. If a new revenue segment arises, if the energy segment surpasses the auto segment, if the existing revenues become more balanced, as investors, you need to keep an eye on the earnings report and see if the company is keeping up with their pipeline of innovation. But as Elon said, if you don't believe in autonomy, which is the main mission of the company, then you should sell. That's going to be it for this video. If you made it till the end, thank you so much. Hit like, subscribe for more, and I'll see you in the next one.